Hi. Let's learn about disposable income. Disposable income, also known as disposable personal income, is the amount of money that an individual or household has to spend or save after income taxes have been deducted. At the macro level, disposable personal income is closely monitored as one of the key economic indicators used to gauge the overall state of the economy. Disposable income is the amount of money that people or families have left over after paying their taxes and other mandated costs. These mandated costs often stem from government legislation. It stands for the portion of income that may be freely spent on discretionary items or activities such as saving, investing, or enjoying leisure time, as well as living costs that may not necessarily be imposed but still needed to survive. Disposable income plays a critical factor in today's economy. It drives how much consumers spend, how much companies earn, and how much people save. By extension, it causes or impacts consumer demand for goods, manufacturing, distribution, and the well-being of the economy. One could argue there are many slight variations to disposable income. In general, the formula to calculate disposable income is disposable income equals total income, taxes, mandatory deductions. Total income represents the entirety of gross wages that an individual or collective society earns. This may be netted against returned wages or sales or other implicit reductions related to the course of earning that direct income. For example, products returned from a customer would reduce a sole proprietor's total income. Taxes and mandatory deductions are often government-sanctioned impositions that an individual cannot be excused from. These impositions may include income tax, other payroll taxes, applicable taxes to one specific geographical region, and compulsory contributions such as Society Security. Discretionary income is equal to disposable income minus all payments for necessities, including a mortgage or rent payment, health insurance, food, and transportation. This portion of disposable income can be spent at will. Discretionary income is the first to shrink after a job loss or pay reduction. Businesses that sell discretionary goods, like jewelry or vacation packages, tend to suffer the most during recessions. Their sales are watched closely by economists for signs of both recession and recovery. The personal savings rate is the percentage of disposable income that goes into savings for retirement or other goals. For several months in 2005 and 2006, the average personal savings rate dipped into negative territory for the first time since 1933. This means that Americans spent all of their disposable income every month and still had to tap into savings or debt to make up the difference. Marginal propensity to consume is the percentage of each additional dollar of disposable income that is spent immediately, while marginal propensity to save is the percentage that is saved. Disposable income is not only important to individuals but holds massive value to society as a whole. Highlights of why disposable income is important includes wage garnishments. The federal government uses a slightly different method to calculate disposable income for wage garnishment purposes. This is the seizure of a portion of a wage earner's paycheck before it is paid every payday until the amount due for back taxes or overdue child support is repaid. The federal government uses disposable income as a starting point to determine how much of each paycheck to seize. The amount garnished may not exceed 25% of a person's disposable income or the amount by which a person's weekly income exceeds 30 times the federal minimum wage, whichever is less. The amount paid into a gross income retirement plan also is deducted from disposable income in this calculation. Real-world examples of disposable income. The Bureau of Economic Analysis within the U.S. Department of Commerce tracks month-over-month change of disposable personal income. For example, from February 2023 to March 2023, the government tracked that average disposable household income increased 0.3%. Should this month-over-month measurement decrease, this means households would have less residual income compared to the month prior to satisfy needs. To calculate your disposable income, you will first need to know what your gross income is. For an individual, disposable income is what is left over after taxes, and is what households used for consumption of needs and wants. Things like rent, bills, food shopping, gasoline, and so on come out of disposable income. What is left over for savings or wants is known as discretionary income. To increase disposable income, one can earn more and/or reduce their tax liability. In aggregate, when disposable income increases, households have more money to either save or spend, which naturally leads to a growth in consumption. Consumer spending is one of the most important determinants of demand. It creates the demand that keeps companies profitable and hiring new workers. Here are 5 key takeaways. 1. Disposable income is net income. It's the amount left over after taxes. 2. Discretionary income is the amount of net income remaining after all necessities are covered. 3. Economists monitor these numbers at a macro level to see how consumers save, spend, and borrow. 4. Shelter, food, and debts are usually paid using disposable income. 5. The government uses disposable income when deciding how much of a paycheck to seize for money owed in back taxes or child support. Hope this would help. Thanks for watching.